Hello there. Welcome back to grade 11 accounting. In this video, I want to look at a question on tangible assets notes. So we are going to go through the question. So this question that we have, which is question 5 from this question paper, and it reads that Google Girl on an event planning business called GG Events. They specialize in weddings at their own venue in the KZN Midlands. So on the required part, you'd see that the first part, which is this part of 5.1, we did it in the last video. So we are just going to refer back to the solution that we came up with according to the last video, and then we can be able to do the part that is according to this video, which is 5.2. So we are going to look at 5.2, which reads the fixed tangible asset note to the balance sheet for the year ending 30 June 2017, and it's got 26 marks. So we are going to go through the information that we are given. We're given information where we are given the following figures. They are taken from the financial records on 30 June 2017. So basically, these are the figures that we are having. And I would see that this part is indicating our opening balances. But you'd see that the other part that we have here from year to year is representing closing balances because it's a 30 June 2017, except for the accumulated depletion figure that is representing our opening balance. So we can just take note of that as we answer the question. Then you go to additional information, you need to go through each and every additional information before you start to answer the question. So this is the information that we have according to the question. Then we can go now to the answer section. You'll see that this is our answer section, whereby we are having our land and buildings, we are having our vehicles, and then we have got equipment. So we are just going to enter the figures accordingly. So we can start by entering the costs. That is the cost for land and buildings, vehicles, and equipment. So we can always get this information in the information that we are given in the question. So you see that the cost are the figures that we are given at the beginning here, which is for land and buildings, we've got 1,438,800. But the figures that we want to indicate here are the figures at the beginning. The figures at the beginning of here. So the cost should be at the beginning of here. But the figures that we are given as our costs are the closest balance, which means they are at the end. So what we are supposed to do is to take note of, for example, we are starting to look at buildings. We have got 1,430,800, but we go to the actual information to see if there's anything that transpired during the year that led to that figure that we are given there as closing balance. Go down and try to see if we have got anything to do with the land and buildings. So if you come with the additional information 1, you would see that we are told that the current wedding chapel was extended for 560,000 rands during the current financial year. This was already recorded accordingly. So what it means, we have got an extension that is there, which is going to increase the value of our land and buildings. So we are going to see that this 560,000 is inside the figure that you are given. Remember, here they are saying this was already recorded, meaning it was already adjusted. So for us to arrive at the figure that we are having there, which is our 1,438,800, we had already added 560,000. So we have to remove it there so that we get the balance at the beginning. Remember, this one is representing the closing balance. So we have to subtract 560,000 from 1,430,800 so that we can have the balance at the beginning of the year. So let's just try to calculate it as such. So we are saying 1,438,800. Then we subtract 560,000. When you calculate like that, you're going to see that you're going to get 878. 878. So this is the figure that is representing cost of land and buildings in the beginning. And then for then we can just try to go and enter that one for land and buildings as our cost. So we are here, we are saying Landed buildings costs, we've got 878,800. Then we can end for vehicles. We go back again to see what are we supposed to enter as our vehicle, as our cost. But if you go to the list of balance, you see that our vehicles cost, we've got 680,000. We need to find out if we have got any we need to find out if we have got any cost, any movements in terms of our vehicles during the year are given in the internal information. So vehicles, it's on information 2, and they're saying depreciation on vehicles is counted at 20% per annum on the diminishing value method. A new vehicle was purchased on 1 April 2017 for 380,000. This has been properly recorded again. So it means this 380,000 is inside the figure that we are given in the list of balances, since we are saying the balance is cost that we are given in there at the end of the year. So we are going to say, to get the balance at the beginning, we are going to say the figure that we have for vehicles is 680. Then we subtract 380,000 that came during the year to get the balance at the beginning. So we're saying so it's still there, we're going to say 300, you're going to get your 300,000. So this is going to be the cost at the beginning. So we go there, and we're going to indicate it as 300,000. Then we can as well go and try to see what can we do in terms of so for equipment. We see that for equipment again we're given 716 here, 760,000. And then we try to see in terms of additional information if you put any other equipment that you are given in the question. So if you come to number 3, it's saying depreciation on equipment is calculated at 10% per annum on the cost price. Note that equipment with the cost price of 20,000 was taken over by Google. So we've got equipment that went out. So we are going to see that in the beginning it was inside the figure that we are given there, but it went out during the year, so it's not going to affect our cost in the beginning. But in the end, that's when we're going to remove it, because it's no longer there. So what we are saying is the figure that we are using here for equipment is 716,000, and this figure is representing the equipment that cost at 30 June 2017, which is at the end of the year. So obviously that 28,000 has been already been adjusted. So what we are saying is we can just maybe try to put it in the form of an equation. Let's say our balance at the beginning is X. Let's just say B, balance at the beginning, and then if you subtract what was disposed to with a cost price of 28,000 according to the question, we can just confirm that figure. We see that it's 28,000. We are going to get balance at the end of the balance in the end then that we are supposed to get there is for equipment, which is 716,000. So let's try to see 716,000. So here we are going to get 716,000. So this is the scenario that we have. Well, this one is in the end. This one is representing in the end. So if you formulate this equation, it's going to lead you to 760,000. So the figure that you want is at the beginning, which is B. So basically we are saying 760,000. You take 20,000 the other side, it becomes positive. So it's supposed to add your 20,000. So at the beginning now we are saying 716. 716 that we have is our cost. Which is our cost at the end. So we are saying 716,000, and then we add our 28,000. We're going to get 744,000. 744,000. So this is the figure that we have for equipment in the beginning. So you can just try to go there and enter it as our cost price. So we are here. So we are saying a year we have got 744,000 is our cost. And then our cumulative depreciation in the beginning, we are given there, the figures are already there. So we are just picking the figures that we are having there. Remember, we are given accumulated depreciation on vehicles. It's 164,000. So it 1 July 2016, which is at the beginning of the year. So these are going to be our balances at the beginning. Then for accumulated depreciation on equipment, we are given this 208,600 at 1 July 2016 again, which is at the beginning. So you can take the figures in there and then enter them. So for vehicles, we are saying accumulated depreciation. We have 164. And then we have for equipment 208,600. And then land and buildings does not depreciate, so we have got no depreciation that we have there. So this is what we have. Then we can be able now to find carrying value at the beginning by saying our costs minus accumulated depreciation, you get your carrying value. Remember, that's the formula that we have, that carrying value is equals to our costs minus accumulated depreciation. So this is exactly what we're going to do here. So for landed buildings, we don't have any depreciation. So we are going to say 878,800 minus 0. We get the same figure, which is 878,800. And then for vehicles, we are going to say 300,000 minus 164,000. And you're going to get your 136,000. Then you go to equipment, we have got 744, and then you subtract 208,600. And then you're going to get 535. 535,400. So this is what we have. Then we go to movements now. On movements, we are going to, for additions, we're going to check where we have got additions. But you'll see that additions, we already have them on landed buildings and vehicles. So for landed buildings, remember, it's stated here that there was an addition of 560,000 here. And then we check again for vehicles here, it was stated that a new vehicle was purchased on April 17 for 380,000. So we just take them and then enter them as they are. In our answer section, so additions, we are here. We are saying additions are on landed buildings, whereby we are saying here we have got 560,000. And then we go to our vehicles, we've got 380,000. And equipment, we don't have any addition. Then you go to disposal at carrying value. So we'd see that disposal is mentioned on equipment, whereby they are saying depreciation on equipment is calculated at 10% per annum on the cost price. Note that the equipment, the cost price, 20,000 was taken over by Google as drawings. So this is the one that was disposed, this one for which was withdrawn. So there are some things that we are going to make a treatment of a disposal since it's going out of the business. So remember, whenever a non-current asset goes out of the business, we are going to make sure that we evaluate whether we made a profit or loss on that non-current asset. So during the process of evaluation, that's when we are supposed to open a disposal account. So in this case now, our credit value at the disposal is also going to use the same formula. We say credit value is supposed to cost minus accumulated depreciation. So already we have got our cost, which is 20,000. Then accumulated depreciation, now we're going to say depreciation that we had at the beginning of the year, which is 11,000 here. Accumulated depreciation on the disposal on equipment or 1 July 2016, which is at the beginning, was 11,000. Then we add the depreciation for the current year, get total accumulated depreciation. So what we are saying is depreciation for the current year, we are told that is 10% of cost. So we're going to say 10 over 100, then we multiply by 28,000. And then we know that it was disposed 31 December, and the year is ending. The year is ending end of June 2017. So we are saying January, February, March, April, May, June, whereby we're having 1, 2, 3, 4, 5, 6. We're having 6 months. So we multiply by 6/4. And then we get depreciation from the beginning of the day until this equipment went out of the business when it was withdrawn as drawings. So we are going to say now 10% of 20,000, obviously you're going to get 2,800, and then you multiply by 6/4, and then you get 1,400. So it's going to be 1,400. Then with this 1,400, so what we are saying is that depreciation for the current day for this non-current asset, which is this equipment, is 1,400. So to get total depreciation now, we are saying depreciation at the beginning, which is 11,000, 11,000 plus depreciation for the current day, which is 1,400 until this equipment went out of business. Then you are going to get your 12,400. So this is accumulated depreciation, which you are going to subtract here 12,400 from 28,000. If you say 28,000 minus 4,400, and we are going to get you 15,600. So this is carrying value at disposal. So this is the value that we are going to put as carrying value at disposal. And we are seeing that disposal only took place for equipment. So we are going to put it in the column for equipment, and we are saying equipment is here. Disposal at carrying value, we've got 15,600, and here we have got nothing. And we go to depreciation for the year. Depreciation for the year, we did calculate it in the last video. So we are just going to refer back to the figures that we are having in the previous video that we did. So let's just try to check depreciation for the year. So for equipment, remember in the last video, we did calculate depreciation for the year for the equipment. So remember, we are saying depreciation for the year is we're adding 1,400 plus 68,800. So we are saying 1,400 is the equipment that went out as drawings, and then 68,800 is the depreciation for equipment that was there for the whole year. So if you say 1,400 plus 68,800, then you get the total depreciation for the year, which is 70,200. So we can just enter depreciation for the year for our equipment as such. So we come here. So we are saying depreciation for the year for equipment. Equipment is here. We've got 70,200. So we are saying 70,200. Then we now try to see for land and buildings, we don't have anything because there's no depreciation for land and buildings. Then for vehicles, we calculate it. Let's try to calculate depreciation for vehicles for the year. But we are seeing that let's just try maybe to remove this. So this is what we have. Then we go to you see that now for our vehicles, we can go to item 2. And item 2 is saying depreciation on vehicles is calculated at 20% per annum on the diminishing balance method. A new vehicle was purchased on 1 April 2017 for 380,000. So we can start by calculating depreciation for the new vehicle. Let's count the number of months that vehicle stayed in the business, 1 April 2017, and the year is ending end of June. So we are saying the whole of April, May, and June. So it stayed only 3 months. So we're going to calculate the annual depreciation, then we multiply by 3/12 to get the depreciation for the 3 months. So we say here, if you come here, let's just try to create some space. So we are saying depreciation for new vehicle. And we are told that it's what is 20%. So we are saying 20 over 100. And then we multiply by the cost of that Remember, we are using diminishing balance method, but this is a new vehicle. It is not depreciation when it was coming to the business. So we've got cost price of 380,000. So we come here, multiply by 380,000 over 1. So we multiply like that. Then the other that we're going to get multiplied by 3. Remember, it stayed only for 3 months times 3 over 4. So we do that. Try to see what we are getting there. Whereby we're saying 20%, then multiply by 380,000. And you're going to get your 76,000. Then you divide by 3, which is 1 over 4. We multiply by 3 over 12, which is 1 over 4, and then we'll see what we get. You're going to get your 19,000. So 19,000 is depreciation for new vehicle. Then we try to calculate depreciation of old vehicles. So we see that the cost, always what we want to calculate. Remember the depreciation using diminishing balance method. We are going to use the formula percentage times carrying value. So first of all, we have to find the figure for our carrying value, whereby we say carrying value cost minus accumulated depreciation. So let's try to find out in terms of the figure that we have for the cost at the beginning. Remember, the cost at the beginning of our vehicles, we have it here, which is 300,000. And the subtract accumulated depreciation at the beginning, we got the carrying value of what? Of 136,000. So we are going to multiply by 136,000, which is our 20%. So we are going to say 20% times 136,000. And we see what we get there. 0.2 times 136,000, and to get 27,200. So total depreciation now is equal to 27,200 for old equipment plus new equipment. We got 19,000 here. We add 19,000. So let's try to see what we get there. And we get 46,200. So this is depreciation for the year. So depreciation for the year for the vehicles, we're going to bring it here, which is 46,000. Depreciation for the year, 46,200, which is supposed to come here, is our depreciation for the year. So this is what we have. Then we are now left with our balances at the end. So our balances at the end now, we are going to say, let's start by the cost. Or land buildings obviously is not going to be affected much because there's no depreciation. So for cost now for land and buildings, we are saying what we had at the beginning is cost plus the addition, 870,800 plus 560,000. We are going to get your 1 million. 438,800. And then for accumulated depreciation, we are going to say we have nothing since we don't have a depreciation for land and building. So obviously we're going to say we have the same figure for carrying value, which is 1,438,800. And then we go to the next, which is vehicles. So the cost for vehicles, we are saying the cost that we are having at the beginning, which is 300,000, plus the additions, you get the depreciation. So we get the cost at the end, which is going to be 300,000 plus 380,000. We're going to get 680. And then accumulated depreciation in the end, we're going to say accumulated depreciation at the beginning plus what we have for the year, give you accumulated depreciation at the end. So we're saying 164,000 plus 46,200 and you're going to get 210,200. Of course, this we are going to subtract it to get your carrying value. Then we go to our equipment. We would accumulated depreciation at the beginning is 206,600. We add depreciation for the year 70,200. And then we subtract disposal. We subtract accumulated depreciation for the disposed non-current assets. So basically, we are saying accumulated depreciation at the beginning is 208,600, and then we add depreciation for the year, which is this one 78,200. And then we subtract depreciation for the non-current asset that is going out. Remember, we calculated it. We calculated the accumulated depreciation for that non-current asset that is going out in the disposal, and we got let's try to see. This is the accumulated depreciation that was taken from the accumulated depreciation for equipment, which is 12,400. So this 12,400 is the one that is representing accumulated depreciation of current asset that's going out. So here we subtract 12,400, and we get the accumulated depreciation at the end. So basically we are saying 208,600, 208,600 plus 70,200 minus 12,400. And we are going to get you 266,400. So this is going to be your depreciation at the end. So what we are saying is now we now have our depreciation, accumulated depreciation at the end is 266,400. Then the cost again, we haven't filled the cost there, so we can as well try to find the cost at the end, whereby we are saying cost at the beginning 744,000. Then we subtract the cost of the disposal. So basically we are saying 744 minus cost at disposal. Remember, there's a non-current asset that was disposed. So if you try to check there, the cost of that non-current asset that was disposed is this one, which is cost price 28,000. So subtract 28,000. So here we're saying minus 28,000. And then I will subtract that, get you're going to get your 716, or you just come here and you take cost of equipment at the end 716. At the end, it's given by this date 2017, which is at the end. You can just come here now and enter with 716. So here we are saying 716,000. So this is what we have. Then you can subtract our accumulated depreciation to get the carrying value. So we do that now. We say under at the middle there, where we put our vehicles, we say 680,000 minus 210,200, we're going to get 469,000. 469,800. 716,000 minus 266,400, we're going to get 421,600. So this is what we have in terms of the calculations of carrying value now at the end, which is the final part of the calculation. So this is what we have, guys, according to the fixed tangible asset note that we have according to this person. So let's stay tuned for more videos to come. Let's subscribe and share. Let's turn on the notification button so that when we upload the videos, you get notified and enhance our preparations as we wait for our final exams. Yes, for this video, I'm signing out. Let's meet again in the next video.